But on the underwriting front, the other thing you got to be careful of, besides accurately mystery shopping your competition, is like that empty facility. You have to ramp. The biggest expense is the payroll. Okay, and you have to factor that in, and you have to ramp that as your occupancy increases, as your census increases, and that's one of the biggest challenges. Is ramping that accurately and not overdoing it, but definitely not underdoing it either, based on how many residents you've got and the caregiver to resident ratio that you're trying to manage, as well as the higher level people like the activities director, the food and beverage director, all these things that you need, the executive director, someone in sales. And again, these people can wear multiple hats, but you've got to ramp that payroll accurately. That's probably the biggest challenge in the underwriting, is to get that right.
Welcome to the Ironclad Underwriting Podcast, where precision meets performance in commercial real estate. I'm your host, Jason Williams, and every week we deep dive into the strategies and systems and stories behind rock-solid underwriting. Whether you're a seasoned analyst, an up-and-coming investor, or a commercial real estate professional looking to sharpen your edge, this show is your front row seat to expert insights, emerging trends, and real-world underwriting tactics that stand the test of time and scrutiny. From market assumptions to debt structuring, cap rates to cash flow, we're cutting through the noise and getting to the numbers that matter. So sharpen your pencils and fire up those models. Let's get to work. This is Ironclad Underwriting. Hey everybody, welcome to this episode of the Ironclad Underwriting Podcast. I'm your host, Jason Williams, and I got my co-host here, Frank Patalano, and we got a special guest with us today. Frank, do you want to introduce him?
Sure, absolutely. Super excited to spend a little extra time hanging out with a good friend and mentor out of Florida, Rod Khleif. Rod has been in the real estate industry for a long time. He's had some amazing wins. He's had some lessons and seminars, but besides that, he kicks butt every day, and I love him a lot. And Rod, welcome.
Oh, thanks, buddy. I appreciate it. This is a real treat for me to actually do an interview with you.
Yeah, definitely. It's been a while. I think we did an interview like 3 or 4 years ago, and
Did we?
obviously,
Oh, that's right, but not on this show. It was something
yeah, not
else,
on
wasn't
this
it?
show.
Yeah, okay, that's what threw me. Yeah.
Yeah.
I forgot what I had for breakfast, and I'm interviewed probably 5 or 6 times a week now. So, forgive me for forgetting that. But that's right. You've got a separate podcast that we did it on. Yeah.
Well, we
So
appreciate you taking the
obviously,
time out for this podcast. So
Sure. Sure. So
so
let's have some fun.
yeah, so I mean, your expertise has always been multifamily, but for the past 2 or so years, maybe even longer than that, I've seen you studying, learning, buying, working on the next big asset class that's already here, which is assisted living
Senior
and
housing, really, in
senior
general. Yeah.
housing. Yeah, I mean, I remember when Gene Garino came around, was speaking about it. I know his daughter Isabel, stuff
Right.
like that, but this is the big
Statutory
stuff.
shoes. Mhm. Yeah. Yeah. We lost Gene to COVID. Horrible. He was a beautiful human being. Now, Gene taught residential assisted living, where you take a house and you throw 8 to 15 people in there. And that's a great business. I actually went to his training in Phoenix a lifetime ago. And yeah, his daughter has stepped in. But yeah, we're more interested in the slightly larger facilities. We're not going to the big stuff in the 200 unit range, but yeah, we've got a 50 unit in Pittsburgh. Give me a little poetic license. It might be a little less than that, but around that. And then we now have 6 assisted living facilities / memory care facilities in Texas under contract. Unbelievable deal. Super exciting. In fact, I don't think I've ever been more excited about a deal. And you're talking about this as a rising asset class. Yeah, my core is multifamily. And by the way, you may not know this, Frank, but we just discovered a week ago Wednesday that my Warriors, my coaching students, as you know, now own 305,000 multifamily units under my tutelage, which is something I'm incredibly proud of. And it's a lot more than that, because not everybody responds to our requests. But senior
Right? And it's not
housing,
counting beds or
no,
hotels or
none of
everything
that.
else.
Yeah,
Yeah,
exactly. Stuff you're
industrial
in.
flex.
None of that. But senior housing is so freaking exciting, because there's 10,000 people a day turning 80 in this country. And honestly, there's going to be a really, I think there's going to be a real train wreck. I think there's going to be waiting lists for these people, because right now what's being constructed is only about 4% of what's needed for the demand. And here's the problem: these things cost minimum of 250,000 a unit to build, and as high as 350,000. I had a guy call me and say, "Hey, you want to raise money for this Orlando assisted living facility we're building?" I'm like, "Okay, give me the numbers." It was 350,000 a unit.
Wow.
And there's still some deals out there. We're paying 40,000 a unit for the 6-pack we're buying.
That's amazing.
So yeah, it's an exciting asset class, but it does get underwritten differently for sure than multifamily.
So, when I think of assisted living or senior housing, I think of what I put my grandmother in when she was like 80, whatever years old. And I mean, it looked almost like a hospital. You go in and there's like a lobby area and then there's separate rooms. Is that kind of what it is? Or
Yeah,
is this like
I wouldn't say it looks like a hospital. They try to make it more homey than that. But yeah, there are separate rooms for each resident, or there's some double occupancy rooms. And so there's actually 4 levels of senior housing. There's independent living, where people get together. Now they may get their meals made for them. They have community events, they have activities, things like that. But then once they need help with things, they need help with what's called activities of daily living, ADLs. Then they go into assisted living. They get help with eating and and clothing and things of that nature. That's assisted living. And then the next step, this really sad next step, is memory care, when people start getting dementia. And then the final is really skilled nursing, which is basically a hospital. I mean, it's that. Now our niche rather is assisted living and memory care. Now we would do some independent living if we came across it, but typically, that's the feeder for your assisted living and memory care. So these 6 facilities we're buying right now in Texas are assisted living memory care. Yeah.
okay. And my grandmother's, I guess, was assisted living on like one side and then the nursing home, nursing care on the other.
Probably
So,
memory care on the other side. Usually they don't combine assisted living and skilled nursing in the same building. It could be, maybe that was an exception, but typically it's assisted living and memory care in the same building. And the memory care is all closed off because, they can
wander
leave
off and
and
stuff. Yeah.
yeah, wander off. There's some horrible stories about that. And so you have to be very, very careful with that. It's a higher level of care. Of course, it's more money, as a cost for the residents. But I believe you have to love the elderly to get in this business. I actually got my administrator's license here in Florida in 2007. Took a course for several days, got my administrator's license. Then, of course, if anybody knows my story, I got my ass handed to me in 2008 and had to back off of it. I started a company. I got the domain name affordableseniorhousing.com. I mean, I was going to go for it, and then my world collapsed, so I had to back off. And now it's like full circle. I'm back at it. So. Yeah, but I do believe you need to care about the elderly to get into the business. This is not just a financial gain opportunity.
Definitely.
Back to the
And
skill levels. Most of the time, you're moving one way across the skill levels, from independent
To
to
assisted, to
to
memory,
assisted
to
and memory
skilled
care.
nursing.
Yeah,
Yeah.
it's rare to ever see anybody go the other way in any way, shape,
Oh,
or form.
no, they wouldn't
Yeah,
go the other way. Skilled
yeah.
nursing is pretty much, the end of the road. It's right before hospice, candidly. And they're in a bed pretty much the whole time. And then, memory care is such a horrific disease. I mean, dementia rather. Dementia is
Yeah,
such a
no,
horrific.
I dealt with it with my mother. We took care of her home. We had 3 people living with her full time. I tried to do it because she wanted it. I asked her, and she's like, "I want to pass it home," and I said, "I will make everything in my power to make sure it happens."
Most people do.
Yeah,
That was a real battle with my mom when she went to assisted living. And we, of course, we packed her room with so much stuff from her house. It was like a hoarder in there. But yeah, it was a challenge initially. And then she actually did get some dementia, but my brother took her in his place in Georgia for the last year or two.
and my grandmother had it.
Yeah.
So it probably was a memory care assisted living that she was in.
Uh-huh. Yeah.
Um, my mom doesn't have it yet. And
Oh,
I
don't
hope
say the word
she
yet.
doesn't.
Let's just hope it doesn't. Yeah.
It runs in the family though, so I imagine she may get it. I hope she doesn't listen to this episode.
Well, I'm going
But
to tell you, I would suggest that you research it, because there's new cutting edge. I mean, with peptides, with everything that's happening, they're starting to discover what causes it. There's a relationship to diabetes. To just study, there could be some supplementation or some other things she could do to thwart it and or prolong it, or maybe even not let it happen. So I would look into it, Jason, seriously.
okay, I will.
Yeah.
But back to, I guess, sort of the numbers of this thing.
Yeah.
Do you own just the building and let like
Yeah,
the
good
doctors or
question.
whatever
Really good
people
question.
run it,
Yeah,
or
really
Operator.
good question. Yeah, I don't want to be an operator. I don't want to take care of the seniors. The liability is very high. Um, so we're doing the real estate piece and partnering with the operators in the facilities that I have already in the ones that we're buying. But that's a very, I won't say precarious, but you want to be very careful who you align with. It's like in the multifamily business. You can live or die by the quality of the property management company you bring on. And I'm actually suing a property management company right now, which is crazy because I was friends with the owners, but they shit the bed so bad on these two assets we have. I didn't have a choice. I would have been in trouble with my investors if I didn't. And so, property management companies, just like operators in senior housing, you need to vet them very, very carefully. So, like the operators that we're working with, I'm looking at, of course, their track record. Have they gone full cycle on deals? How are they doing with their occupancy? But even deeper than that, what's their culture like? Do they take care of their employees? Because these aren't the highest paid, the caregivers aren't the highest paid people on the planet. And so do they validate their employees? Do they motivate them? Do they educate them? Do they, empower them? How do they hold them accountable? All these things that are super important that you want to see an operator doing. And how happy are their people? What's their turnover like? We're buying these assets from Brookdale, these six in Texas, and um, you know, they're so top heavy. They've got an activities director in every facility, food and beverage director in every facility. And these people can wear multiple hats, which is what the operator that we're working with there does. Because, a lot of these, again, they're top heavy, like any big, Brookdale's the largest in the country. Any big organization like that, there's so many freaking levels of management. It's ridiculous. And so we're going to be able to massively cut the expenses. We've reviewed the expenses on their existing facilities. And so we know it's real that we'll be able to do that. But those are the things you want to look at, with an operator. Be very, very careful because you live or die by the quality of that operator.
so
How many
operator, you
beds?
mean the
Sorry.
company that's
I mean
running
the people
the
taking care of the
caregivers?
seniors.
Okay.
Right. We're doing the real estate piece. Like right now we're raising 7.2 million for this six pack of assisted living facilities. And like I say, we're paying 40,000 a unit, which is crazy because you can't build them for less than 250 to 350. The numbers are ridiculous. We've actually had to downplay the pro forma so it doesn't look too ridiculous. But yeah, we're just doing the real estate piece, and we've got a great operator that's going to manage these, that already has assets in these cities. They're 99% occupied. We did our pro forma at 85% occupied because if we'd have done 95, it would have just looked ridiculous. But again, I don't think I've ever been as excited about a deal as I am about this particular deal. So yeah, that's where we're at on that. And I think there are still opportunities to buy some of these facilities that are poorly run or got crushed by COVID. We bought an asset in Pittsburgh that was completely empty that got crushed by COVID, and a lot of them did. It was very, very sad. And so, there's still some opportunity to snap some of these up, at greatly reduced pricing, less than than they cost to build, like the ones we're buying. And we're hitting it hard. I've got a full-time cold caller calling facilities and setting
Wow.
up. We're hitting it hard. So. Yeah.
What kind of, obviously, not counting your new deal that you're talking about, what kind of returns can the average investor expect?
Oh, buddy, that's so deal specific. I mean, we're quoting 15% cash on cash and 24% IRR.
That's all I
And
wanted to hear. Perfect.
yeah, and candidly, we are massively underselling it. Okay. I'm just telling you, you know how conservative I am anyway. Out of those 305,000 units, I believe we've only seen one deal get lost in the Warrior program that I know of anyway. So, I teach people to be super conservative and make sure you have plenty of operating reserves, in case what hits the fan, and stress test every piece of the analysis and all of that. So, yeah.
What about people that go out there and say, "Oh, you have to be a nurse to do this"?
Well, you need a nurse to help with, an RN, or a nurse practitioner to be able to do meds. So you've got to have that license in your facilities in some capacity. But certainly don't have to be a nurse to own the facility. I mean, this is someone you hire. I mean, I know people that set up, longevity clinics and the facial stuff, the Botox and all that stuff. And they just hire a doctor to come in and qualify the businesses. And so, hell, I did it in real estate. When I gave up my broker's license, I hired a broker and set up a real estate company so I could get the commissions on things I was buying. And I paid him a few $100 a month qualified. So it's the same thing in this business.
But what I'm saying is that there's on your active ownership team, you have an operator that's separate. You don't have anybody that has to be a nurse.
No, of course not. Of course not.
Yeah.
No, we're in the real estate business. I'm not in the senior housing business. Now, do I know a lot about it? Yes. Do I care a lot about it? Yes. Am I going to be having a spotlight on what they're doing on a weekly basis? Yes. Are we going to be managing and monitoring KPIs on a weekly basis? You better freaking believe it. Do we have the ability to remove the operator if they, what the bed? Yes. So
Perfect.
all of that, it's not like you close on it and we're done. Okay, let's go, have our cash flow. No, that's when the work started. It's called asset management. And so, we're heavily involved until, the assets are, go full cycle, get sold, whatever.
Are you guys doing secret shoppers?
Oh, yeah. We've done all that, on every one of these facilities, we shop the competition. And that's one of the things that's a little more challenging in this because, and so let's shift to underwriting, at least what you just said. In this business, there are levels of care. And some people will do a low initial price, and then for every additional activity of daily living they need help with, they upcharge. So it's difficult to really do comparables. You have to do it, but it's much harder than just going and, okay, what's your rent on your 2-bedroom? What's the size? Like a multifamily, you're just, it's much, much easier, as long as you're comparing apples to apples. Well, here there's apples, oranges, pears, grapes. You've got all these different scenarios and how they price the care. And so, we spent a lot of time doing our market research for competing facilities to figure out where we needed to be, because again, they do it differently. And we're very conservative there as well. Super conservative in what we anticipate we're going to charge. So, yeah.
So your residents, the ones who are, I guess, being assisted, is like Medicare or insurance?
Yeah,
or...
that's the government pay. We're not doing that. We're only doing private pay. Now, if you're going to do government pay like Medicare, Medicaid, you better check out the state you're going to do it in. It's not very good in Florida, for example. And candidly, I'm for what it is in Texas because we're doing private pay. They pay it themselves. And luckily, the baby boomer demographic has a lot of money. Their houses are paid off. And they use those houses typically to pay for the care. And so, this is the greatest transfer of wealth we're going to see in our lifetimes. It's happening right now. 10,000 people a day are turning 80. 10,000 people a day are turning 65. You look at it on a graph. Sorry about the analogy, but it looks like a rat going through a snake. Okay. And so, the baby boomers have impacted every part of society. The diapers back in 46, 47, suburbia was from the baby boomers, and now it's senior housing, and it's a crisis. I'll be honest. I think it's going to be a crisis in this country. I think there will be government intervention because they're just not. So, it'll be very interesting to see how it all shakes out once, these facilities are full. And, there's not enough beds there for people because they need the help.
Rod,
you were lucky, Frank, you had family to help your mother, but that's not always the case.
Yeah, no, I agree with that 100%. There wasn't family, it was friends that I helped, that I paid. I had the assets and the means to do it. So for you, I know you're focused right now on buying properties or assets that have issues. Have you? I know a few warriors are doing it. Are you considering doing any building yourself?
I would love to, but again, the cost is $250K a bed minimum, or unit minimum, units a room minimum, and so the numbers are tough, man. And so, I'd rather buy existing. And yeah, a lot of the warriors, we went to the NIC conference, NIC. Don't ask me what it stands for, but it's the big senior housing conference. I've gone to the last two. There were a bunch of my coaching students. Their warriors were there, and yeah, they own a ton of property already. They're killing it. So it's really, and of course this last warrior event, I get my warriors together, as you know, Frank, for to network and stuff. This last one, I spent 2 hours teaching senior housing. So, yeah.
So what about conversions, like converting a multifamily into senior
Yeah,
housing?
very challenging for a lot of reasons, not the least of which, if you've got interior hallways, there are width requirements. But the big one is your ability to get them out of the facility if there's a fire and what your sprinkler system can handle and all that business. Some states require backup generators with the fuel for the generator. So there are a lot of factors, to do that. Now, some people have taken hotels and converted them.
I was wondering about
But again, all these things have to come into play as to how, I forgot what the word is to when you have to get them out. There's a phrase in the business for it. But anyway, there's some big hurdles. I mean, it's like people's like, I'm going to convert an office building to multifamily. No, you're not, because it's all in. What are you going to do with the interior rooms with no windows and no egress and all that stuff? And the cost of the putting in plumbing and electrical and all that, forget it. So there are a lot of hurdles to converting to assisted living. Now, if a facility was previously skilled nursing or assisted living or independent living or things like that, that's a whole lot easier. And we're finding some of these empty facilities. In fact, my cold caller just sent one over, 50 unit that was empty that we're talking to about it. Of course, that's much easier. Now, then you've got to go ahead and get it licensed and all that stuff, which is what we did in Pittsburgh. It took about 6 months to get the license, and
wow.
the operator hired the people and got it going. And of course, we raised enough money for about an 18-month runway, which is what it takes to get that thing filled, and that's okay.
Do all the units have to be like interior units, or can you have like a bunch of townhomes or duplex type?
Yeah, that's
complex?
challenging. Yeah, that's challenging because you've got to feed them and you've got to get them to a common, dining room.
Common area. Okay.
Yeah, and so that can be a challenge to get them, from one building to another, 3 times a day for meals. So it's much easier to have them in one
Especially
building,
in colder
or at
states.
least all connected in some way.
Well, I was just thinking here in North Texas. I mean, I just walked a property that's like half the units are like townhome type units. So
For independent living, I would guess. Now, I doubt that they're 2-story, because elderly cannot go upstairs.
yeah.
Yeah.
So-
Now, if they're, single-story townhouses, that would likely be independent living. And then maybe there's a building for when they get into assisted living that's all, together. Where if they're
Okay.
independent, they can walk to the dining room. But yeah, that comes into play.
Yeah. Okay.
What
So
about the concept
let's
of it
talk
being?
about underwriting. Let's talk about
Yeah, go ahead.
underwriting for a second, because it is the name of the show. So we kind of got. I mean, I think this has been a good framework, hopefully, for your listeners. But
Definitely.
But on the underwriting front, the other thing you got to be careful of, besides accurately mystery shopping your competition, is like that empty facility. You have to ramp. The biggest expense is the payroll. Okay, and you have to factor that in, and you have to ramp that as your occupancy increases, as your census increases. And that's one of the biggest challenges, is ramping that accurately and not overdoing it, but definitely not underdoing it either, based on how many residents you've got and the caregiver to resident ratio that you're trying to manage, as well as, the higher level people like the activities director, the food and beverage director, all these things that you need, the executive director, someone in sales. And again, these people can wear multiple hats, but you've got to ramp that payroll accurately. That's probably the biggest challenge in the underwriting, is to get that right. Okay. And you can do it. I mean, an operator can help you do it, but you want to be careful and conservative when you're doing that. Now, this is not like a multifamily where you're going to rent 10 rooms a month, most likely. Okay. So, you've got to be conservative in your, occupancy numbers as to how many per month you anticipate getting. Now, the operator can help with this. Like Brookdale, these facilities we're buying, they rely on websites like A Place for Mom. They're not doing any guerrilla marketing whatsoever, going in, talking to hospital administrators, going in, talking to home health care people, and that's what this operator that we're working with does. And that's why they're 99% occupied on their facilities that they manage, because they go out there and they meet the community. They figure out, they get relationships with doctors. And that's how you get the referrals to your facility. They do open houses, things like that. But so you got to be very conservative in your ramp up, from the occupancy standpoint, but also from carefully inputting the expense component, particularly as it relates to payroll. And of course, food comes into play, because the food will increase as you get people, and I'm just trying to think what else. But those are the biggest differences between assisted living, memory care, and multifamily. Now, also in the memory care component, those people are higher paid. You need more of them. So that's a factor as well. So all of this comes into play when you're doing your underwriting to make sure that you carefully allocate for the increase in census and the caregiver component to that, the food component to that. Yeah.
So Rod, you're conservatively underwriting at about 85% occupancy.
Well, this six pack,
Yeah.
we're underwriting. My operator is 99% occupied. We
No, I
could
understand
easily have put 95 in our pro forma, but we did 85 because it would have looked ridiculous if we put 95. And and by the way, if you're accredited and you're interested, text the word partner to 72345. I think we still got a couple million left. Partner to 72345 if you're interested in checking that out. But it's, like I said, it's the most exciting deal I've ever been in so far. So, but yeah, no, it's the demand. See, here's the thing though. They call it the silver tsunami. It's like a tidal wave of these elderly. So if there was ever a tailwind on a demographic or on an asset class, this is it. It's not like multifamily is getting crushed right now because of adjustable rate debt and high expense ratios and everything like that. By the way, the expense ratio on these assets is typically in the 75 to 80% range. Okay.
Like hotels.
Okay. Yeah. Oh, is it? Okay. Yeah. But there's such a huge tailwind here. It's like, honestly, you'd almost have to be an idiot not to make it work, candidly, as with what's coming. Now, the past with COVID and everything, it's understandable that, some of these assets, got crushed. But, there is definitely an operational component to this as well. When we're buying these assets from Brookdale, the largest operator in the country, and they can't get the occupancy up because they're top heavy, their expenses are high, they're not going out there and getting the business. We walked into some of these facilities and they're lackadaisical. They don't get up off their desk when you come in, see who you are. You can just tell. It's ridiculous. And this is the largest operator in the country. Yeah.
Culture.
So yeah, it's culture. Exactly. And so, anyway, it's a very, very exciting asset class. There's a lot of opportunity in the asset class, and yeah, I'm very excited about it. I'm still doing multifamily, of course, as well, if we've come across deals, but, and they're coming. Oh my God. Merrill Calliser, who, the SEC attorney, does a lot of work for the Warriors, got 6 apartment complex foreclosures in one day. Yeah, I mean, and he did a State of the Union this last Warrior event, and talked about the distress in the marketplace for multifamily. But yeah, anyway, we love this asset class and very excited about it. And again, the tailwinds are just incredible to help support it.
So I know you do a lot of like boot camps and stuff on multifamily. Do you do boot camps on assisted living?
No, we don't yet, although I teach it to my warriors. Now, yeah, I do a virtual boot camp, multifamily now pretty much every 30 to 40 days. And if you don't mind, let me mention it if it's okay.
That's fine.
It's now $25 for 2 days of training. I don't sell anything there. And here, listen to the bonuses. Okay, I mean, I made it so irresistible. You'd have to be an idiot if you're interested in real estate not to do it. So you get for $25, nothing being sold, 2 days of training. You get my 15 module multifamily wholesaling course. You get my document library. You get my deal evaluator software for multifamily. You get my #1 best-selling book. You get my Finding Deals course, and you get my Courage and Confidence course. Like all of that for $25. Hell, even if you don't come to the boot camp, it's like $6,000 worth of stuff. We're selling the wholesaling course for $2,500 on my website. So to give you an idea, I've discovered that the people that add the most value are the most successful in this country. All you do is look at people like Elon and Jeff Bezos, and there you go. And so I've tried to always add as much value as I can. And that's what I'm doing. So if you're interested in that boot camp, text boot camp to 72345 or go to rodsbootcamp.com. Or you could go to rodslinks.com. Actually, that's probably better. Go to rodslinks.com. That's my link tree. My bootcamp site is there. My free book section, there's tons of great free books there. My podcast link is there. And, I'm blessed now to have the largest really commercial real estate podcast in the world, which just blows my mind. But all of that's there at rodslinks.com. You could text links to 72345 to get that link if you're driving. But yeah, I do one of those almost every 30 to 45 days. And then I'm thinking about doing a boot camp about senior housing. I just haven't had the bandwidth to set it up.
In person?
In
person?
Oh, I'm thinking about doing an in-person boot camp in Orlando here in December. I've been thinking about it hard because
I
I
am
miss it.
ready. I am
I
ready.
miss it. Yeah, I miss it, man. But but the virtual is right now is coming up very soon. I don't know when this is airing, but I've got one in the end of July, and I'm doing like every 30 days or so.
I think we're about 3-4 weeks out right now. So
Yeah.
Okay.
So they'll probably get it right in time.
yeah,
Okay,
and
perfect.
we'll put all of your links and everything in the show notes.
Yeah,
and descriptions.
rodslinks.com is the best place. And if you're accredited and you want to check out that 6-pack, partner to 72345, just text it. It's partner to 72345. But I appreciate you guys having me on. Hopefully I added a little value. I know I didn't get microscopic on the underwriting, but
Perfect.
okay.
You've left a lot open for us to dig into in the
Good.
following episodes. So
Perfect.
I might have to hit you up in some emails or something to get some more further clarification. Just so we can...
Happy to do that, buddy. Happy to do that. Yeah.
Okay.
Pleasure to meet you, Jason and Frank. It's always a pleasure.
Thanks, sir.
It's nice meeting you, and thank you for showing up. I know you have a busy schedule, so.
You have no idea. Anyway, thanks, guys. I appreciate it.
You have anything else, Frank?
No, I don't.
So, all right, we'll catch y'all on the next episode. See y'all later. Bye. And that's a wrap for this episode of the Ironclad Underwriting Podcast. If you got value from today's conversation, make sure to subscribe, rate, and share the show. And don't forget to connect with us on LinkedIn, YouTube, Facebook, Instagram, or check us out at our website at ironcladunderwriting.com for more insights and updates. If you have a question, a deal you're analyzing, or a topic you want us to tackle, shoot us a message. We'd love to hear from you. Until next time, keep your assumptions grounded, your models sharp, and your underwriting ironclad.